in fact, anybody listening, if signing that first renewal offer that you get from your lender will probably be the worst mistake you'll make in terms of the thousands of dollars that you will lose, because banks and lenders almost never offer the best rate on their first renewal to you.
Dion Begg, how you doing, my friend?
I'm good, man. It's been quite a while.
It has been. It has been. Good to see you.
Yeah.
We were supposed to start a little bit earlier, but you ended up in my Oshawa studio.
You
forgot. I didn't tell you.
You have too many offices.
I didn't tell you that you're coming down to the red throne chairs.
And these are beautiful chairs. They are.
Yeah. Good, man. Well, listen, thanks for making the trek up from Barbados. For anybody who doesn't know who you are, I mean, we've known each other now for a number of years. What do you do? You're a mortgage agent, but... But you do some different things as well.
That's right. So I run a mortgage team. We help Canadians secure their mortgages for their purchases and their refinances. But I built my team to serve clients through every stage of their life.
Yeah.
So that's all the way from preparing to buy your first home to then becoming debt-free, setting up your own kids with their homes, which we'll talk about a lot today, and also setting up your own retirement. So as much as we are a mortgage team, we really approach this with a long-term view, sort of a financial planning focus, and figuring out how can these mortgages serve your greater picture that serves your life in general.
Yeah. So I want to get into some of your specialties as well, too, because I think, the first thing is working with self-employed. And a lot of times people who are self-employed, they make an X amount of money. It could be 150, 200,000, but they're only showing the tax man that they're making 30,000 or 40,000. And so a number that is significantly lower, which causes obviously issues getting a mortgage. Let's touch on that first and kind of dive deep in how you're helping, whether it be real estate investors or people who are trying to get into home ownership that are in that particular scenario or situation.
For sure. I meet a lot of very frustrated business owners who have been successful and smart enough to build their own business. It might be making them hundreds of thousands or millions of dollars a year. And yet when they go to the bank to secure a mortgage, they run into a brick wall. And it's because banks like things to fit into a nice little box, and entrepreneurs don't fit into boxes. That's why they are where they are, because they don't fit into the employee frame. So you are correct. As a self-employed person, your top line revenue is not the number that you pay yourself. You can legally write off a whole bunch of expenses that individual employees can't write off, and as such, you might make $200,000 a year, but on paper you make 40. Okay.
Right.
So if we look at that as an example, $40,000 might get you a mortgage of maybe $200,000, which really doesn't buy anybody anything today. But the self-employed person says, Dion, I can make a payment of $5,000 a month, and I know that $5,000 a month is the payment on $1 million mortgage. And so the question is, how do these people qualify based on the fact that they don't actually fit inside the regular paperwork that the bank wants? So the first thing I'll say is we help many self-employed people who've been to a bank and get rejected. Once we look at that paperwork and we can figure out ways in which to present the information properly, we can often take them back to the same bank that said no to them and get them approved. Okay? And it's kind of weird to say, Gary, like some of my clients work at banks too, and they get declined from their bank. And when I take them back to their own bank, presenting the information that we uncovered through our discovery call and investigation in their numbers, we often get those deals done. So if I go back to the self-employed for a second, a lot of bank employees are limited in their knowledge of mortgages. Now, it's because, and I forgive them to some extent, because a bank employee often has to do a bunch of things. I think I'm talking to a former bank employee now who not only have to do mortgages, but mutual funds, insurance, understand checking and savings accounts, and a whole bunch of other things. And so they may not understand all of the potential ways in which you can get a self-employed person approved. So one way is that we can actually use business profit as income with major banks. So here's an example. Let's say you paid yourself $40,000. You left all the rest of your profit in the business, and the business made say 140 grand, paid some tax, and you still have 100 grand profit after tax in your bank account, in your business bank account. Okay. A lot of people don't know this, and the bank employees don't know this. You can use that 100 grand as income, not as net worth, as income, as if you had paid it to yourself.
So the amount that's sitting in your bank account.
This is net income after tax.
So this would be like, say, for like a real estate agent, this could be sitting in your prec.
100%. And we've helped many real estate agents who...
I just realized there's something on your knee there. I'm not sure what that is. Now, maybe, I think I had him crawling around, helping me plug some wires in. But anyways, we'll get that out of the way. Okay, go. Anyways, continue.
Yeah. So, so a lot of real estate agents who have incorporated in the last couple of years.
Yeah.
Been smart about it, but again, they pay themselves very little, and all their money is held in their prec.
Yeah,
we can actually use that money as income.
That's interesting. Yeah, I don't know if I realized. I mean, I'm not a mortgage agent, but obviously that's why I think it's so incredibly important for people who are looking to get into whether home ownership or they're an investor is to sit down with experts.
Right. Yeah.
You know, and you're saying like even some of these people are bank employees, and then you're actually giving them the ideas and tools to be able to get into where they're trying to get to.
Correct, yes. And, the thing is, as much as this information exists, unless it's a problem that a person solves in their business daily, it's not something that people would become aware of, right?
Yeah.
So it's something that because I would say something like 60 to 70% of our files contain at least one self-employed person. We might have a teacher and a plumber, right? And the plumber is self-employed. And so because so many of our clients or files have a component of self-employed, we've had to become experts in terms of what actually is doable. And a lot of people think it means that they're forced to be pushed into private lending, when in fact that's not always the case. Sometimes it's the case, but only after we've explored every other option. And that first option is, is there a way we can make you fit with an A lender or a major bank? Now, another way that we can make people fit there is through a different program called Net Worth. Okay.
Yeah.
So let's just say, again, that self-employed person who's kept their retained earnings in that bank account for many, many years. Let's say that they qualify for a mortgage of 800 grand, but they need a mortgage of 1.2 million. So they're short 400,000. If we can demonstrate that they have net worth, this is liquid net worth in the forms of stocks, bonds, mutual funds, some other types of investments, even RSPs. Also qualify for this, TFSAs. If we can demonstrate that we have this amount of money, this 400 grand that we're short, sitting in liquid assets, then the fact that they are there allows us to borrow up to that additional 400K. So while on paper your income qualifies for 800, if you've got that 400 liquid, we can now push you up to a $1.2 million purchase.
Right. Okay. Interesting. And so you were saying also too that maybe sometimes they don't fit into that box.
Yeah.
And then what other boxes do you now start to take a look at outside of, say, somebody now who's claiming less, but you're now able to get into what they're trying to get into because they've got money in their prec or they've got money in RSPs or TFSAs.
Yep.
But let's say if they don't,
sure,
are there any other tools?
So if this recognition of business income or net worth is not possible for this particular client, then we would transition to the next level of lending. And just so everybody understands, there's effectively 3 levels of lending. There's A lending, B lending, and private lending.
Yeah.
So if we don't fit in the A box, the next question is, can we get into the B box?
Right.
And what B lenders, the first thing I'll let everybody know about B lending is they do not care about your tax returns. They do not care about your notice of assessment. Okay. They don't even want to see those documents for the most part. What B lenders are most interested in is one word. Was it 2 words? Depending on who you ask, it's cash flow. Okay. So how much cash flow is coming into your business and how much revenue are you probably keeping based on bank accounts? So they're only focusing on bank account history, and they're looking at the last 12 months of your bank account history.
And when you say B lenders, for somebody who's listening and they don't know what a B lender is, what does that mean?
Okay. When I say B lenders, some people think Harold the jewelry buyer. That's actually who they think, right? Or they think some kind of loan shark in some dodgy strip mall somewhere. In fact, B lenders in Canada are major Canadian institutions that have been around for decades. Some of them are companies like Home Trust, which was at some point owned by Warren Buffett's company, Berkshire Hathaway, as well as Equitable Bank, which is a chartered bank now. And there's probably about another 5 or 6 B lender type lenders that we work with pretty regularly.
Yeah.
They deal with billions of dollars of mortgage funding. And B lenders are sometimes a bridge to A lending. So I don't want people to think that if you end up with a B lender, you're dealing with less than savory characters, right? You're dealing with major institutions that are listed on the TSX that have helped many people for many decades.
Yeah, and I'm glad you brought that up, because a lot of times when people hear that from the mortgage agent, they're like, a B lender, oh, these interest rates are going to be way too high. And a lot of times they're still fairly competitive, aren't they?
Yeah, no, that's a good point. So when we're dealing with B lending, we're looking at rates that are usually 1, maybe 1.5% higher than the major bank.
Yeah.
And there are fees involved that people need to be made aware of, which are scaled based on the file as well.
Right.
But I'll give you a quick example. I had a client recently who was not going to buy a property, but we showed them a B lending solution.
Yep.
The B lending solution turned out to be about an extra $10,000 over the course of the mortgage. And I said to him, look, you're going to buy this property. I think the number was like 800 grand. You're going to buy this property for 800 grand. Would you still be buying this property if it was worth 810? If you had to pay 810? That's the real question. And he said, yeah, I would. And I said, well, if you put it in that context, this financing does make sense for you.
Right.
Right. So just look at it as
a way to kind of break it down.
Right.
What other pieces are different, say, in the B lending space as opposed to the A lending space? And again, I don't know if we touched on this, but A lending would be like your RBCs and your TD banks,
major banks,
and your Scotia.
Sure, sure. So with the B lending space, they're going to be looking for that cash flow. They will look at top line revenue. Let's keep it simple. Let's say your business makes 10 grand a month.
Yeah.
Okay, but it's clear that you have an employee who you pay 3 grand a month, and it's coming out every month on the same day, 3 grand a month. So they're going to recognize that is a fixed expense, that employee. They're also going to factor in some standard things such as use of cell phone, maybe rent if you rent a property, rent a space, insurances, those types of things. So they're going to do some basic math, and if that basic math shows, okay, you gross 120, but you net 80, then we can use that 80K number.
Got it.
Right.
Okay, and then our third one, and is this the last one? Or
this would be probably...
so this is your C now. This is your C, and this is when you get into privates.
Private lending, correct. Yeah. So with private lending, the key difference here is that some of them don't even want to see income. They don't really care about income. Okay, some do. The reality is the more documentation you can present, the likely better product, better rate you're going to get.
Right.
But the private lenders are really focused on the asset, meaning that they're making their lending decision based on the idea. And by the way, what I'm about to say goes for all lenders. Lenders want to know that if there is ever a default on their mortgage, that the asset that their money is secured against is something that they can quickly take to market and sell to get their money back. Most lenders are not interested in keeping property. They're interested in getting their money back. So when it comes to private lending, there's a lot of weight put on the ability to take that property back to market. It's called marketability. So as long as you're buying in a location that's marketable and type of property that's marketable, you're likely going to find a private lender who, I'll tell you, in the last couple of years, a lot of them pulled back on their loan to value, 65 to 70%. I'm now seeing more up around 80 and even 85% are coming back to market, because I think a little bit of confidence has returned to the market, depending on location and asset type, right? So, and yes, you're looking at higher interest rates for sure. Here we're looking.
And what's your range?
Yeah, so I mean, it depends on the loan to value. So
for sure.
I've recently got a private mortgage at an interest rate as low as 5.5%. on a 65% loan. Okay, so a lower loan, therefore lower risk. Once we start pushing up higher, like to that 80% number, you can expect those rates to jump to 9 to 10, maybe even 11%, depending on the lender. And I know some people here listening would be, falling off their chair, like who in the world would pay for that type of an interest rate?
Yeah.
And again, whenever we put somebody on a private lender, we want to know what is the plan for exit. Right. Because a private lender is not your forever lender. Your private lender is a lender that you go to as a bridge on your way to a better place. And in many cases for our clients, they know that, okay, my husband just lost his job, but he's got his resume out there. And we know that within the next 6 months, he's going to be back at that same position, earning 150 grand a year. And even if he doesn't make 150, he'll take a lower paying job at 100 grand a year just so that we can, get out of this mortgage. Right. Some people are waiting for other assets to sell. Some people are waiting for credit to repair because of some drama they had in the past. But before we sign the commitment for a private lender, the client has to tell me what is the plan. And we actually sign off on what that plan is, so that we're all in agreement of what the plan is after you actually take on this debt.
Yeah. And that's a good point to bring up, because it's really important to understand that this is not a forever place that you want to be when you're dealing with private lenders. This is, you're going to get out in 6 months, or you're getting out in a year. What is your plan? Are you re-educating yourself? Are you going to put it on the market? Are you selling it? But you don't want to be sitting in this rate for many years, because what ends up happening, and I'm sure you see this as well, is that they renew, and then all of a sudden now it's 3 years goes by, 4 years go by, 5 years go by, and the equity is getting completely eaten up.
Yeah.
And then you move into a market like we saw in 2022, where now the equity starts, the value of the home starts going down, and now there's nothing left to take out. And then now that private lender starts to pull back, and then now they've got to put these homes on the market to sell.
Yeah, so we've seen situations where, fortunately, we didn't put people into these situations, but they've come to us to try and salvage the property, where they borrowed so much and the property value has dropped so much that now they owe more than what the property is worth. Put simply, you owe $1 million, your house is worth $950, right? And so people come to us in those situations, and what was absent when they took that mortgage is the conversation about exiting. Like, what is your exit? So whomever put them into that mortgage didn't put together for them, or formulate for them an exit strategy, and coach them. Like, all of our private mortgage clients, they hear from me regularly. Are you on track? We're 6 months out from refi. Have you done the things we said you needed to do in order to get back over to major B lending or A lending?
And what ends up happening sometimes as well too, which I've seen, is where now they do the prepayment for the whole year in advance. And now they get comfortable with no payments.
No payment, yeah.
And now all of a sudden 2 years goes by and they get comfortable with another year of no payments.
Yeah.
Right. So it can get really tricky really fast. Right. And I mean, we know also too, a lot of real estate investors use it, where they're using it for flips or using it to, force appreciate the home. So there's a lot of different ways to use it, but you got to know what you're doing.
Yeah. And see, in every example you just gave, they have a clear exit. They have a plan and a clear exit. It's the people who don't formulate that clear exit who are going to be in trouble. Yeah. And, you've probably seen on Treb, the number of power of sales has increased quite significantly, and the majority of them are probably with private lenders.
Yeah. And I while you've touched on it as well too, because I do want to move into a next segment here, but where do you see things going for next year, where you're seeing more power sales come up, and do you see that getting worse in 2026? Because interest rates now, what are interest rates at now? 2.25 the bank rate.
2.25 at the Bank of Canada, which means you're borrowing plus or minus 4% today, which is a big relief for people who got their mortgages a couple of years ago. We're happily right now actually breaking mortgages at 6s, paying penalties, and putting them into lower rates, because the saving on that lower rate outweighs the penalty that clients paid a couple of years ago.
Right, because they might have a year and a half left or whatever it may be, and it just makes sense to get into that lower rate over the next, you lock them in for 3 years or 5 years, whatever.
Exactly. In fact, a realtor just last week who we helped a couple of years ago, we got him the best rate at the time, and now we're breaking that mortgage. He's going to save about $17,000 by breaking that mortgage over the next 18 months.
Right. Yeah. So if anybody who's listening and there might be in a situation where maybe I shouldn't break it, or I don't know if I should or not, have that conversation with somebody like yourself to be able to guide you to run the number and saying you are going to save, or no, just stay where you're at.
And what I would say to anybody listening is, if your interest rate is at 5.25, 5.25 or higher, then it's probably worth the question, worth investigating. It only takes a couple of minutes to run those numbers, and this is what we do every day.
Right.
Yep. I feel like I got off track there.
We did though, because we were touching on, where do you see the market going next year with power sales happening, and is that going to increase? Because these interest rates, even though they've come down, and I think people are so optimistic that it was going to save them, but there's just some people that just can't be saved by it, who have just taken on too much debt in 2020, 2021, 2022?
Look, I mean, the reality is many Canadians over these last couple of years, as rates went up, were doing everything they possibly could to stay in their home, okay? That means that many of them went into credit card debt. They went into second mortgages or payday loan type stuff, and we're seeing more and more of this, unfortunately, over the last couple of years. And so couple that with what is happening in the economy, right? So I don't have the crystal ball, but I can tell you what I see on the street level is, national unemployment's at 7%, Toronto unemployment's at 9%. Okay, it's well beyond a safe and healthy metric, which should be closer to 5%. I'm seeing the reduced immigration affecting the education industry. A lot of my clients work in education. They're professors at George Brown or Seneca College, and they're telling me there are no children to teach, no students to teach right now because of change in immigration and student visa allocations, right?
Okay.
So that's happening. People in manufacturing calling me. One of my clients makes granola out in Kitchener, Waterloo, and all of the inputs into his granola come from overseas and via the United States, right? And then his product sells to the United States. So he's been decimated from tariffs on the inside, on the inbound and on the outbound. Vehicle manufacturing, a bunch of my clients work in that sector, and they're also impacted. Construction, okay? How many new construction condominiums are starting this year? Hardly any.
Yeah.
So as I say these words, I'm hearing the horror story that I'm just describing to you.
Yeah.
I'm not a negative guy. I'm a realist, okay? And the reality is the Canadian economy is impacted from all sides at the moment. With all that being said, what that means is those people who have been holding on for dear life are going to be pushed over the edge.
Right.
Okay. As the economy, is impacted. So I would dare say that it is unfortunate that this year we're likely going to see more people reach their limit. I would say to you, if you are one of those people, do not wait until you run out. Okay. Until you run out of cash. Now is the time to proactively work with a realtor, mortgage person, whoever it is, to plan for worst case scenario. And sometimes when a client calls me and I look at their numbers, I say to them, you must call, the minute you hang up with me, you must call your real estate agent, because it's better for you to sell your property than for the lender to sell your property.
Right.
Okay. So, the reality is that's happening more and more.
Yeah. And, what you just said, look, I'm a guy who's half glass full, but I do see what's happening out there in the streets. I definitely see it. And I jumped back into the market. I was talking to somebody the other day to see what my agents are dealing with. And you go into some of these homes, and let's say I look at 5 or 6 or 7 homes, and out of those homes, 1 or 2 agents will call me and say, I need an offer because they're about to go into power sale.
Right.
Like, bring me something, like anything, put it on paper. And so you're seeing that in those homes where they bought them for 1.4, 1.5, and now they're down into like 1.1 million. And so and you'll probably see more of that. And the other thing as well too, is I think this year and also next year is the largest amount of mortgages that are come up for renewal. Right. So I'm sure you know this, and now where they're sitting at 1.5%, 2%, they're going to be going up into, high 3, low 4s. Yeah.
So let me talk about that for a second, because that wave actually already started in the last couple of years. Yeah. And, there are people who are at 1.89 on their 5-year coming into renewing at 4%, say. Yeah. And the interesting thing is that the majority of people have been able to make it work.
Interesting.
Right? They knew it was coming. Yeah. They knew it was coming. And a doubling in interest rate doesn't mean a doubling in payment, just so everybody understands. Yeah.
Right? So and what do you typically see? And obviously it depends on the price of the home as well.
Sure, too, but let's just say anywhere between $500 and $1,000 a month is what we're seeing. Yeah. Okay. Now, some people say to me, Dion, it sucks, but we can manage it. Okay. Some people say, we can't manage it with all the other debt that we've accumulated. And that's a simple answer, which is let's roll that debt into your mortgage. So if you've since picked up a car payment of $700 and a personal line of credit and credit card payment of $400, and now you've got $1,100 in consumer debt in addition to your mortgage payment, I can understand that that's not going to work. But when we roll that consumer debt into a mortgage at a lower interest rate, amortized not over 5 years like a car loan, but maybe over 30, what happens is that $1,100 payment now drops to $100 or $200. Right. And now they go, we can deal with this higher mortgage payment because we got rid of all of our consumer debt.
Right. So you're doing a reconsolidation of debt, put in the mortgage if you're able to do that. So there are ways and strategies and plans that you're implementing for your clients.
Yeah. And I mean, if people are scared, it's almost always the case because they have outside debt. Right. And if we can take care of that outside debt and roll it into the mortgage, we're good. Yep. And the last thing I'll say too is many of these people started on a 25 or a 30-year AM. And maybe when they come to renewal, they're at 20 years remaining on their mortgage.
That's a good point.
A quick fix is for cash flow alleviation is to just stretch that mortgage back out to 30 years.
Now, do you have to do any documentation to do that, or can you just go right back up to it? Is it like
it depends on the lender, but in most cases we are having to requalify, right?
Okay.
And also, it's almost always the case that we're rolling in some other debt, or we're allowing for a future payment. So, guys, if you're coming up to a mortgage renewal in the next year, what I would say is think about right now, what are the expenses you're carrying on the outside, be that the car payments, credit cards, and other things. Also think about what are the impending future payments that are coming up. So the ones that we hear a lot of, I have to buy a new car soon, or I have to get new windows, which are going to cost me 30 grand in my house, or do a renovation because my child is going to stay with us for longer, right? And we need access to 100 grand. So all of those things are important to think about, not in the week before you renew your mortgage, but in the year before you renew your mortgage. And so that when your mortgage is up for renewal, you know that, okay, we're approaching this more from, again, this financial planning perspective, rather than, oh, let's just sign the piece of paper and, be done with it. In fact, anybody listening, if signing that first renewal offer that you get from your lender will probably be the worst mistake you'll make in terms of the thousands of dollars that you will lose, because banks and lenders almost never offer the best rate on their first renewal to you, right?
Right.
If they sense that there's a mortgage broker involved, suddenly they sharpen the pencil. Suddenly the rate drops by 0.1, 0.2. So even if you think you just want to stay with the lender you're at, you don't have any of these cash flow concerns, it would still be a mistake to just accept the first offer they give you.
Right. Yeah, that's a good tip. Because a lot of times people just accept it. They get it in the mail, and
because it's easy.
You know what? I'll just take this rate and move on, because I got other things going on. But yeah, you should definitely sit down and
I just had this conversation with a client the other day. He's like, "Oh, is there going to be paperwork involved?"
Right.
And I'm like, "Yes, there will be paperwork involved." But I said, "Let's break this down." And I sat down and I worked out how much this man makes per hour. He makes pretty good money. He makes about $150 an hour. And I said, "This will take you 3 hours, and this will save you $5,000."
Right.
So, $1,300 an hour. How does that sound?
Right.
Or whatever that number was, $1,500 an hour.
Yeah.
He's like, okay, when you put it that way, it does make sense to go to the trouble of digging up some paperwork in order to get a better rate, a better deal, better cash flow.
Absolutely. Let's switch gears a little bit. Let's move into some of the new mortgage rule changes. What are they? And if you can kind of maybe go through a few of them where you think they're good or maybe they're not good.
Sure. Okay. Yeah. So we'll start with insured mortgages. Okay. So up until the end of last year, the longest amortization you could take on a mortgage was 25 years under an insured CMHC mortgage for first-time home buyers. But again, the government recognizing that the monthly payment, the affordability factor, just really wasn't there for these first-time buyers. They have agreed to extend that amortization to 30 years. Now, there's two arguments as to whether or not this is a good thing. Okay, many people will say on those against this extension of amortization say, well, all you're doing is you're putting young people into debt for longer, and that is true. Okay, it's an extra 5 years. Okay, on the flip side, it's these young people would not otherwise be able to become property owners if that payment wasn't slightly lower. They would maybe forever be renters. Okay. Yep. And so, when I look at those two arguments, I can see the merit in both of them, but I err on the side of, hey, owning something a little bit later is still better than owning nothing.
I agree.
Ever.
I agree.
I mean, the extreme version of this, Gary, is the orange man down south coming up with the
50 year.
The 50 year, which he threw out again. And the same argument stands on both sides, right? Yeah. It sounds absolutely ridiculous. Am I jumping up and down saying, yes, we should do this? No, I'm not. But when you look at the math and you ask the people that it impacts, would you be okay paying an extra 400 grand over the 30 years to actually end up owning a property? I think many of them would actually say yes. So I'm not a proponent for it, but could I see if property prices don't change and interest rates don't drop dramatically and wages don't change, affordability is not going to change.
Right.
And if affordability doesn't change, then the reality is that many young Canadians, and young now by today's definition is under 40, right?
Yep.
They'll never own.
Yep. And listen, that's a really good point there. Let's continue it, right? And we're going to take a little break, and we'll jump right back into that. But hold that thought.
Got it.
All right. Awesome.